In 2022, something happened that sent a shock through financial markets, and it threatened the very foundation of mainstream investing as we know it, the 60/40 portfolio. But here's the thing. The conditions that existed then still exist today, but most investors are completely oblivious to them. The traditional 60/40 portfolio, that's 60% equities, 40% bonds, has defined mainstream investing for decades. Just like treasuries are the benchmark risk-free return in financial markets, the 60/40 portfolio is the benchmark or reference portfolio construction when it comes to mainstream investing. What makes the 60/40 portfolio so popular amongst investment advisors? It all has to do with a historically negative correlation between stocks and bonds. What we mean by correlation is how two asset classes historically behave or perform when compared with one another. If you go back to the origins of modern portfolio theory, Harry Markowitz discovered that if you can combine assets with low to negative correlation with one another, you may get better risk-adjusted returns in your overall portfolio performance. Now, better risk-adjusted returns is the holy grail of investing. All else being equal, you'd want to risk less to gain more than risk more to gain more, or of course, risk more to gain less. Finding assets with low to negative correlation with one another is the key to unlocking true diversification for investors. And it's the key to unlocking better risk-adjusted returns. Now, most investors want diversification. As the late, great Peter Bernstein said, diversification is the only rational deployment of our ignorance. That's because most of us are not professional investors. We're not analyzing stocks or looking at the market all day, every day. Even the professional investors out there, the ones who do this for a living, even they have a hard time beating the S&P. So for most of us, we're after true diversification. And that's because diversification gives us several key benefits. 1, it helps us survive in multiple different market environments. 2, it gives us the ability to set it and forget it. We don't have to worry about the particular earnings of one company or another company making or breaking our investment returns. And lastly, true diversification is designed to automatically do the thing that most investors want to do anyway, which is to buy low and sell high. Think about it. If you have a portfolio that's 60% weighted to stocks and 40% weighted to bonds, and the stocks end up increasing in value whereas your bonds decrease, you're going to have to rebalance. In order to execute that rebalancing, you need to sell the asset that has outperformed, the stocks, and buy the asset that has underperformed, the bonds. So in the very act of rebalancing your portfolio into the target weights, you're selling the asset that has increased and buying the asset that has decreased. In other words, buying low and selling high. Now, the reality is that the 60/40 portfolio has performed remarkably well over the last 5 decades. A regularly rebalanced 60/40 portfolio has achieved historical returns just shy of 8% annually. And it's achieved that performance throughout a number of different broader macro environments. So it's with good reason that the 60/40 portfolio has become the mainstay, the anchor of mainstream investing as it exists today. However, there are market phenomena that can cause that inverse correlation between stocks and bonds to break down. And one of those phenomena is inflation. In 2022, inflation started rearing its ugly head in a big way. And one of the consequences of inflation coming back to market is that it caused that inverse correlation between stocks and bonds to weaken. And it didn't just weaken, it broke down entirely and slammed into reverse. For several months, stocks and bonds were performing almost identical to one another, causing many professional money managers to sound the alarm. Research from notable financial firms, including AQR and Barclays, have shown that inflation specifically poses a risk to this inverse correlation between stocks and bonds. And if that inflation stays and persists, it can cause that inverse correlation to break down. This is where we find ourselves today. The inflation that began in 2022, even if it's a little lower today than it was then, it's still with us. In fact, there are some indicators suggesting that it's about to heat up again, with Trump threatening additional tariffs and the passing of the big, beautiful bill. In other words, as long as this inflation stays around, investors are at risk of this negative correlation between stocks and bonds weakening and exposing their portfolio to additional downside risk. This raises the question, what can investors do to protect themselves? Well, the first thing to say is that we shouldn't throw out diversification. diversification. Diversification may still provide all the same key benefits that we discussed earlier. What would be helpful is to find other asset classes with equally low or negative correlations to both stocks and bonds. And here's the good news. You don't have to go looking very far to find one of those assets. One of those assets is, you guessed it, gold. Gold has a low to negative correlation, not just to bonds, but to equities as well. So great, we found another asset, gold, and this asset has the same low to negative correlation with stocks and bonds, just like in the 60/40 portfolio. But now what? You still have the problem of thinking about how to incorporate gold into your portfolio. Should you replace the bonds with gold or replace the stocks with gold? Before jumping to replacing those assets altogether with gold, you should be aware that you don't actually have to replace any of those assets with gold. You can simply add gold to a portfolio of stocks and bonds and potentially achieve better risk-adjusted returns. We've done the research on this, and the historical data shows that even with just a 4% allocation to gold, that's 4% allocation to gold, 57.6% in equities, and 38.4% in bonds, the portfolio with just the 4% in gold achieved better risk-adjusted returns than the traditional 60/40 portfolio that has zero gold. If you're interested in reading that analysis for yourself, just click the link in the show description and you can access that white paper for free. Now, if you are thinking about replacing some of those assets, the stocks or the bond portion of your portfolio with gold in order to protect against inflation, you have to keep in mind that inflation doesn't impact stocks the same way it does bonds. The impact of inflation on equities tends to be dispersed. It will impact certain companies in unique and different ways. Whereas with bonds, inflation impacts bonds head on. Inflation attacks bonds in two ways. First, the principal value of the bond is eroded away due to inflation, and the interest income payments are eroded away due to inflation. So of the two assets, replacing bonds with gold may have the greater benefit. In fact, there have been some historical studies that have shown that if you completely replace the bond portion with gold, you could actually see better returns. Both Meb Faber and Bob Elliott have shown that if you swap bonds for gold, you can maintain or even improve the risk-adjusted returns of that portfolio over the historical time series. You can see in the analysis that Meb Faber did that when he replaced bonds with gold, he achieved a slightly higher overall portfolio performance while only adding a little bit of volatility and improving his Sharpe ratio. To be clear, we're not saying you should drop bonds altogether. We're simply saying that you should consider gold for the very reasons that Meb Faber demonstrated. The fact that gold has outperformed bonds and the data suggests that you could replace bonds entirely with gold is remarkable. Not to mention, gold has a lot of advantages that bonds don't. For example, gold isn't subject to central bank interest rate manipulation. Gold has zero credit risk. Gold has zero currency risk. Gold has proven itself resistant to inflationary pressures. And lastly, gold can't default. It can't go to zero. So if the data on gold and bonds is so clear, why is it that most mainstream investors don't own any gold? In fact, it's actually worse than that. Gold is one of the most underowned and underrepresented asset classes in mainstream investing today. And it's not just in retail. Gold is underowned even among institutional money managers and family offices. Our friends over at the In Gold We Trust report had a great graph showing the average portfolio composition of family offices. About 58% of that portfolio was in traditional asset classes, and about 42% were in alternative asset classes. Of that alternative asset class portion, only 1% was allocated to gold. So you can see that even among the professional money managers, the ultra high net worth crowd, gold is still severely underowned. And we have to ask ourselves, why is that? Especially when the data is so strongly in favor of gold. I think there's three principal reasons for why gold continues to be underowned today. And they all happen to start with the letter I. It's the three I's of why gold is still so underowned. First is inertia, second, incentives, and third, income. Let's take each of those in turn. First, inertia. Traditional mainstream investors continue to choose bonds over gold, mainly because of institutional inertia. Bonds are traditional securities. They're familiar. They are well known in mainstream circles, and they've been owned and invested in for decades. Everybody knows that everybody knows you should invest in bonds. It's practical, common, and well understood by both investors and advisors. Whereas with gold, gold is seen as new. It's seen as an alternative. It's even seen as fringe and risky. And so for most people, there's just an institutional inertia that has been built up over decades, which favors bonds over gold, despite what the data suggests. Number 2, incentives. We also need to look at how incentives may play a role in why gold is underowned. Most financial advisors are paid on a fee-only basis, and more often than not, that fee is taken as a percentage of their AUM, their assets under management. Because bonds are traditional securities and gold isn't, bonds more easily fall into that AUM figure. To try and include gold in that AUM because it isn't a traditional security introduces all sorts of complexities and challenges for financial advisors. Therefore, it shouldn't come as a surprise that most advisors are more likely to recommend bonds over gold, because to do otherwise would directly impact how they're compensated. So you can see how this incentivizes advisors to not be so quick to recommend gold, because if they do, it could actually result in them getting paid less. After all, as the famous quote by Upton Sinclair says, it's difficult to get a man to understand something when his salary depends on him not understanding it. Now, this isn't to assume or accuse your advisor or any advisor that they're acting in this way. It's just meant to highlight the underlying reality that there is an incentive structure at play, and it doesn't favor gold. And as any longtime follower of monetary metals knows, incentives matter a lot. While important to keep in mind, incentives alone don't explain why gold is still underowned today. Because the reality is that there are gold-related securities out there, such as GLD and mining stocks, that can be included in that AUM figure for advisors. So incentives alone don't answer the question completely. There has to be something else. That brings us to number 3, income. Gold is underowned because gold doesn't produce an income. And guess what does? Bonds. Bonds pay interest income, and gold traditionally does not. We can't underestimate this one, because ultimately everyone needs an income to live, especially during those retirement years where you may not be able to work as much as you used to. So your savings and your investments must produce an income. Otherwise, you run the risk of outliving your savings. And the fact that bonds pay an income and gold doesn't is a strong reason for why advisors would recommend owning bonds over gold. But here's a question. What if gold could produce an income too? How might that change the paradigm for investing in gold? And not just for investing in gold, but for what advisors may choose to recommend to their clients in their portfolio construction models. The objection that gold doesn't produce an income is outdated, because this is precisely what monetary metals does. We offer gold with income, a yield on gold paid in gold. And we deliver that gold income, or gold fixed income, as we like to say, in 2 distinct vehicles: gold leases and gold bonds. In a gold lease, clients can lease or rent their gold to qualified businesses who use it as inventory or work in progress. And in a gold bond, clients lend their gold to businesses that use that gold to either finance expansion or as a catalyst to get into production. In either a lease or a bond, at the end of the day, clients are earning interest income on their gold paid in more gold. These gold yield opportunities offer clients the ability to earn a real income from a real asset, and the potential to strengthen their overall portfolio position as it relates to stocks and bonds. But how do the yields of gold fixed income investments compare to dollar fixed income investments? Right now, you can get just under 4% in dollars in a money market fund, whereas in our gold leasing program, you can earn up to 4% in gold paid in more gold. Each of our leases in our lease program has a 12-month term or less. Our gold bonds offer higher rates, anywhere from 5% to as high as 19% paid in gold. Please keep in mind that our gold bonds are available to accredited investors only. If you want to learn more about how gold can impact your portfolio and how specifically gold with yield can impact your portfolio, we encourage you to download our free white paper, The Case for Gold Yield in Investment Portfolios. We run the analysis going all the way back to 1971 and show how adding gold, and specifically gold with yield, to a historical portfolio can improve that portfolio's returns. It's completely free. Just click the link in the show description. The investment landscape is changing rapidly. Persistent and higher inflation poses a threat to investors who either aren't aware and aren't prepared. Gold offers a way to protect your portfolio against this threat while still giving you the benefits of diversification. And owning gold with yield just makes owning gold better. We invite you to check out the analysis for yourself. Download our free white paper by clicking the link in the show description and let us know what you think. If you found this video helpful, let us know by hitting like and subscribing to our channel. It sends an important signal to us to make more content like this, and it will help others find this video as well. Thank you.